Joining us right now about what to expect today is Lauren Goodwin. She is economist and chief market strategist at New York Life Investments. And Lauren, thanks for coming in today.
Oh, thanks for having me. It's great to see you.
Okay, so this is a big deal. We get PPI today in less than 2.5 hours. We're going to get a look at this inflationary data. And after the strong jobs number on Friday, that has everybody thinking, uh-oh, if this is a hot number, what does that mean for the Fed? What do you expect to see today?
Well, both for PPI today and CPI tomorrow, the survey of forecasters is expecting 0.3% increase headline, a little lower for core. And that's just because energy prices have been moving higher. I think that's about right from an expectations perspective, but there's a couple of things I'm watching really closely. The first is actually in the CPI prices tomorrow, because one of the major contributors to the market narrative that underlying inflation might be okay, sticky to a little bit lower, was the fact that shelter prices had been moving lower. If that reverses this week, then I think we see a risk to the market. The second thing on both of these inflation prints has to do with policy uncertainty. We see in business sentiment as well as consumer sentiment more and more folks becoming concerned that tariffs and other policy changes may increase inflation moving forward. That can't be known, but it's definitely in the market atmosphere, meaning that an upside to either of these prints is a downside to the market.
So if there is a hotter than expected number today, will people brush that off, as you said, if this is energy prices that are picking up, or do you think you have a nervous market that is already looking for reasons to be, inflation may be back? I mean, that seems like the story in Treasury yields for the last couple of weeks, really focused on the inflationary picture.
It is very much so. In fact, yields have been moving higher since December 6th. And looking at what really that was, it was the November jobs report showed that after some deceleration in payrolls over the few months prior, actually the economy was holding up pretty well. The labor market was holding up pretty well. That means that the market and the Fed are much more focused on these inflation prints. And so for the market, what that means is that good economic news, that activity is pretty good, maybe inflation firming, that's bad news for the market. And so if we see an upside, even accounting for higher energy prices, I'd expect that to prompt some market volatility.
Okay, every time we see Treasury yields go up, we see tech stocks sell off, we see other stocks sell off as well. And I guess there's a point where, okay, this is a concern about inflation, this is a concern about the national debt and deficit. But then you get to a point where, hey, this looks like a pretty good deal if I can have 5% in a 10-year, and maybe some money actually chasing that as a safer place to hang out.
That's right. That's historically been the case, and I have no reason to expect that that wouldn't be the case this time around, in part because U.S. yields are outperforming other parts of the world. You still see U.S. Treasuries as a relatively safe asset with that higher yield. And so I would expect that as we inch closer to 5%, even a little bit before that, we would start to see institutional buyers coming in, taking advantage of this opportunity. And look, even for retail investors, if over the last few months people didn't get into the market before the Fed started cutting rates, this provides a second opportunity to get into fixed income and capture those higher yields. The one point of caution that I've seen on the street and that I agree with is that you could see a brief moment of yields over 5% if we see policy noise at the same time. As you mentioned, one of the reasons why yields have been moving higher is concern about the supply and demand for Treasuries. And so if we get announcements around tax or spending around the same time, then you could see yields surpass 5% briefly.
When you are coming from New York Life Investments, I make an automatic assumption that you are going to be a little more cautious about what you're telling people to do, that you might stick more to Treasuries or other sorts of places that maybe wouldn't have the same risk impact that the markets would. Am I right to assume that, or am I wrong to assume that?
Yes and no. So New York Life Investments invest money on account of third-party investors, so not the insurance principal, right, which is very carefully and closely guarded. Of course, third-party money is carefully and closely guarded as well. But when we think about the balance of Treasury investments as opposed to risky assets, that's really about the market. And one of the high conviction views that we've held with respect to Treasury investments, especially on the longer end, is that duration, on average, not our favorite place to take risk. And that's because we expect high and more volatile yields to be a feature, not a fluke, of the next several months of investing. Absolutely. I mean, it's already been the case, right? Seeing the economic resilience as well as policy uncertainty that we have in the market. And so that's an environment where we're quite active in the market. I mean, if yields are moving higher, it's at least in part because the economic backdrop is good, the credit backdrop is good. And so we are invested in credit, public and private, but we're sticking shorter duration, at least on the corporate side of that credit equation.
And what do you think of stocks?
Equity valuations are high, but that doesn't tell us anything about market timing. And so we're really, more than anything, looking at earnings quality. My expectation for the next 6 months, let's say, is that if the equity market moves higher from here, it has to broaden. We have to see more participation. And it's our expectation that we will see that broadening, even if we don't see price earnings multiples expand. So that's a bid for not necessarily selling off the exposure you have, but any new money diversifying into dividend-paying stocks, for example, different exposures from the tech that's dominated the market.
All right. I like your volatility in yields as a feature, not a fluke, kind of like the tech bro way of looking at some of these things. It's a feature, not a bug.